Most of us try to build our wealth using the usual suspects, right? We're talking stocks, bonds, maybe some real estate. But what if I told you there's a hidden powerhouse out there in the investment world? It's true. Long-term studies actually show that diversified early-stage startup investing has historically cranked out 22 to 27% annual returns. That dramatically exceeds the public markets. But, well, here's the catch. While the upside is absolutely extraordinary, executing this strategy well is just insanely difficult for the average investor. So, welcome to today's Explainer. Today, we're going to look at a structural evolution that completely flips the script. We're going to explore why venture studios consistently outpace traditional venture capital, and specifically how MKS Global Ventures is leveraging a massive, and I mean massive, unfair advantage to build and exit companies faster than ever before. Okay, let's dive into this. Here is our roadmap for the Explainer today. 1. The traditional VC flaw. 2. Venture studios outperform. 3. The MKS unfair advantage. 4. Real-world proof with Blue 222. And 5. A better way to invest. Section 1. The traditional VC flaw.
To really grasp why a totally new model is taking over, we first have to look at why the old model is, well, kind of broken. The traditional venture capital system is fundamentally a hits-driven business, and it is built on top of a staggeringly high failure rate. Right now, roughly 75% of traditional startups fail completely. They just go to zero. And that massive failure rate forces traditional VCs to play a very specific, high-stakes game. So I want you to ask yourself, what if the best venture returns didn't actually come from unicorns? Traditional venture capital is entirely obsessed with finding that next billion-dollar company. I mean, they literally have to be. They need one massive exit to cover the spectacular losses in the rest of their portfolio just to pay back their investors. But relying on these massive lightning-in-a-bottle exits just to return a fund, that's an incredibly risky narrative, especially for individual investors.
Just look at this number, 0.07%. That is wild. Traditional venture firms are effectively targeting the mere 0.07% of companies that actually reach that billion-dollar unicorn status. This creates a highly skewed strategy. Think about it. Most of your investments fail, a few might, return your capital, and you are essentially left crossing your fingers for an extreme statistical anomaly to bail you out. Now sure, that model might work just fine for the mega funds out in Silicon Valley, but it leaves everyday investors with highly asymmetric risks. It simply isn't optimized for consistent, repeatable wealth generation.
Let's jump to Section 2. Venture studios outperform.
Now, what's really interesting about this is the massive paradigm shift we're seeing in early-stage investing. Venture studios don't just sit back, write checks, and hope a founder figures it all out. Instead of just picking winners, they manufacture them. They act as institutional co-founders. They identify real market problems, build the initial product completely in-house, and provide shared infrastructure, actively engineering the company's success right from day one. And the actual performance data, it shows a stark contrast. When you look at the research from the Global Startup Studio Network, studying hundreds of studio-backed companies, the results aren't even close. Traditional VCs sits at an average internal rate of return, or IRR, of 21.3%. But venture studios, they completely eclipse that with a 53% average IRR. So what does a 53% IRR actually mean for you? Well, it means venture studios have the potential to double capital every 18 to 24 months. By controlling the earliest and most critical stages of company creation, they dramatically compound value so much faster than traditional venture or the public markets. Let's break down the math here to show exactly how that actually impacts ownership and value. Imagine a standard initial investment of $500,000. In a traditional VC firm, that capital might buy some preferred shares, yielding roughly a 1x multiple on the value created by the conversion date. Pretty standard, right? But check out the venture studio approach. Because the studio operates as a true co-founder, putting in the sweat equity, the formation capital, and all the operational systems, that exact same $500,000 investment translates to 3.4 times the total equity value. And even more importantly, it results in 14 times more value created above the initial investment. They create a completely disproportionate amount of equity because, frankly, they're actually doing the heavy lifting of building the business.
Section 3. The MKS unfair advantage.
So the crucial point is, if the venture studio model is the superior vehicle, MKS Global Ventures has effectively strapped a rocket engine to it. Let's explore how their deep, shared operational infrastructure takes this whole concept to a completely unmatched level of execution. MKS Global Ventures starts where most venture studios can honestly only dream of. When they launch a startup, that company is instantly backed by a colossal structural advantage. We're talking over 500 computer programmers, over 150 mechanical and electrical engineers, a massive 24,000 square foot prototyping and manufacturing facility, an embedded supply chain management group, and a dedicated business commercialization group. They don't have to go out and hire these people one by one. The infrastructure is already right there. And this entire ecosystem is backed and guided by experienced operators who have already achieved a billion-dollar software exit. This entirely compresses the time it takes to build a product and almost completely removes early-stage execution risk.
And because MKS has this massive infrastructure on tap, they don't need to chase that elusive 0.07% unicorn. Instead, MKS deliberately targets the 25% of companies that successfully exit in the $25 million to $50 million range. These mid-sized exits are far more common, they are highly predictable, and significantly faster to achieve. MKS designed these companies for capital-efficient growth with clear 4-year exit horizons. They are aiming for consistent, repeatable singles and doubles rather than just swinging blindly for the fences and waiting a whole decade for liquidity.
Section 4. Real-world proof with Blue 222. And this brilliantly illustrates exactly what we're talking about. I mean, it's one thing to talk about infrastructure and exit strategies in theory, right? It's another to see it actually applied to the market. So let's look at a prime example of this capital-efficient company building in action. Meet Blue 222. Blue 222 is an AI-driven platform designed specifically to modernize the highly fragmented world of real estate inspection and due diligence. This isn't just some tech solution looking for a problem. This is a highly targeted attack on a massive, outdated industry with very clear workflow inefficiencies.
The pain point they are solving here is severe. Right now, real estate due diligence involves these fragmented emails, endless phone calls, manual coordination. It's a mess. By leveraging that massive MKS engineering bench, Blue 222 built an AI-enabled orchestration system that replaces 14-hour legacy email processes with literally just minutes of agentic AI. And by agentic AI, I mean the software actually takes autonomous actions to complete the work for you. And because MKS focuses on commercialization from day one, this wasn't built in a vacuum. It was designed alongside actual enterprise design partners who have already processed tens of thousands of projects nationwide. Real workflow pain solved instantly by shared infrastructure built strictly for a predictable exit.
Section 5. A better way to invest.
Let's move to and see how this builds into a practical reality for you. How can you get involved in this outperforming asset class without being some Silicon Valley insider? Historically, access to top-tier early-stage startup investing was heavily gatekept. Traditional funds demand exorbitant minimum investments, they lock your money up for 10 to 12 years, and they offer zero transparency into the actual deal flow. But MKS Global Ventures is completely decentralizing this model. For accredited investors, MKS provides direct access with minimums starting at just $10,000. You get exposure to a diversified pipeline of highly engineered companies built by proven operators with professional oversight from day one. It is truly the democratization of high-yield company building. To wrap up our explainer today, I want to leave you with this defining philosophy from MKS: disciplined company building over speculative investing. The days of just throwing money at a slick pitch deck and praying for a unicorn, those days are fading fast. With modern AI, deep shared engineering infrastructure, and a hyper-focus on repeatable $50 million exits, venture capital is fundamentally changing. By aligning with a venture studio that brings over 500 programmers and proven operators to the table, you aren't just betting on a startup, you're investing in a sophisticated company creation machine. So are you ready to stop speculating and start investing in structural certainty? Thanks so much for joining me today, and we'll see you next time.